A very good morning, everyone. My name is Axel Frelfel, Reuters editor-at-large, and I am delighted to be moderating today's webinar. The webinar is entitled The Future of Crude Oil and is supported by the Al-Attiyah Foundation in partnership with Refinitiv. The Al-Attiyah Foundation is, of course, an independent think tank that aims to provide practical and robust knowledge and insights on global energy and sustainable development topics, and then communicate those for the benefit of the Foundation's members and its community. A few things to note before we start. If you've got any technical issues during the webinar, you can click on the chat bubble, outline the problem you're having, and one of the admin team will assist you. Please click on the three horizontal buttons next to the red X to activate the Q&A and poll windows on your screens. If you've got any questions for our speakers, click on Q&A and type your question in that box. Do be aware, though, given timings, we may not be able to address all of the questions coming through. During the session, I'll introduce three separate polling questions that we'd love to hear your views on. I'll prompt you and you'll see them appear on the screen in front of you. And finally, this session is being recorded. A recording will be circulated to all attendees after the webinar has ended. Right, just before we start, let me very quickly bring you up to speed with the latest news from Reuters. I'm sure you're all well aware of the challenging context for the oil and gas sector as a result of the pandemic, fears of a slow pickup in post-lockdown demand, as well as concerns over storage capacity. Oil prices did have a little bit of a reprieve over the past few days, but that seems to have come to a halt now. We're edging lower again right now. It seems a jump in US inventories has reawakened those fears of oversupply, at least for now. Brent crude futures hovering around $30.90 or thereabouts. WTI is at $24.39 right now. Certainly looks like the road to any semblance of a rebalancing in this market will be a rocky one. I'm going to bring the first poll up, and you should see this on your screen in just a moment. There you go. Based on the region and industry you represent, when do you think economic recovery will happen? A, late Q3 or Q4 2020, B, the first half of 2021, and C, late 2021. Have a think about that, and whilst you're doing that, I will introduce our speakers. Alan Gelder is VP of Refining, Chemicals and Oil Markets at Wood Mackenzie. He is responsible for formulating Wood Mackenzie's research outlook and integrated cross-sector perspectives. Surasan Sadati is a Senior Research Analyst for Shipping and Oil Research at Refinitiv. His team generates insights for real-time trading using trade flow analytics and pricing data focused on primarily on Middle East and North African markets. I know you have a short presentation, Surasan, and we will come to that in a moment. Let's quickly, if we can, have a look at the results to this first poll if you've had a go at it. We'll put the results up in just a second. Hopefully that will come up onto our screens as we talk. But what I'm going to do in the meantime, whilst we're waiting for that, is introduce, or is at least ask Alan to get us kicked off with some brief headline thoughts on what's going on and how things might play out. In fact, Alan, let me ask you this question in particular. How rocky will the rebalancing of the oil market be in your view? How long before we see any normalization in supply and demand?
The question of normalization is a fascinating one. Depends what you define by normal, really. If you reflect that in terms of, say, price as a measure of normality, Wood Mackenzie's not expecting a normal world until arguably the end of 2021, where normality means you've got oil prices that are not that dissimilar from 2019 levels. So we're forecasting high 50s, high 50s towards the end of 2021. So it takes a fair amount of time to get there, and there's a huge degree of uncertainty. And that's really driven by the events of this year have been quite dramatic. we started off the year, we had the US killing of the Iran's Revolutionary Guard leader, General Soleimani. We had the near war with Iran. We then had US-China trade deals established, now being threatened to return, so trade challenges returning. We've had Libyan's port blockades. We've had coronavirus that shut down economies all over the world. Oil demand collapsing. WTI going negative for a day. And now we've seen the green shoots of recovery over recent days, because it looks like for this first phase of the pandemic, the demand Rubicon has been crossed, and we've got demand in China recovering, and we've got US gasoline demand recovering. It's shown something like 15% growth over the last 2 weeks compared to the lows of early April. So we're starting to transition from governments setting lockdowns, which drives the economy, to actually lockdowns being eased, so economic activity starts to deliver demand growth, and we start to revert to this world, a more normal world where government policy, debt levels, investment, employment are key drivers of demand. But the world has been through quite a shock demand-wise. Supply side, the OPEC group has announced unprecedented cuts that came in less than a week ago, and we've seen dramatic changes in non-OPEC members. So US production has fallen very strongly. You've got cuts from Brazil, Canada, Norway, and there's the concern of storage because inventory levels are very high and there's lots of floating storage. So there's a huge amount of uncertainty in this market at present.
All right, we'll come on to storage a little bit later on if we could, Alan. We've got the results to that first poll in. 12% say late Q3, Q4 2020. The majority, 56%, say the first half of 2021, and the rest say late 2021. That's on economic recovery, and I'll ask your view in just a sec, Alan. Just to reiterate, though, Wood Mackenzie say high 50s for the price by the end of 2021. Is that right? I just want you to reiterate that. Yeah. Okay. What are you saying on economic
assumptions in that space?
Okay. Yeah. What are you saying on economic recovery?
Well, we think this year global GDP will be down something like about 4%, 4 percentage points. So we'll end up with, think of total GDP growth, and this is done on a real basis, typically is 2 to 3%. We think this year will be -4, but what we'll have is the worst part of that impact is now, and then when you're talking about economic recovery, it's all about from what your basis is. So that we think as lockdowns are eased, economies start to return, so we start to recover from now on in. But it's only towards the end of 2021 will you be at GDP levels that are higher than where we end when to this crisis. So again, what's the basis? Always a good one, but we think as economies will recover, but they're very much constrained this year, and then it'll be towards the end of next year when you're higher levels.
All right, Alan, thank you very much indeed for those opening thoughts. And as I said, we're going to come back to Q&A after we've heard from Sura-san. In fact, just before I throw it to Sura-san, I'm going to bring you the second polling question, because this sets Sura-san up nicely. And there it is, the OPEC plus cut, or the OPEC plus the OPEC plus cuts took effect from May 1st. Do you think the headline numbers will be effective? And look, the clues are in what we've seen happening, I guess, in the price since the beginning of May. But let's get your responses on that over the next few minutes. And whilst we're doing that, let me give the floor to Sura-san. As soon as that poll result comes through, I will bring it to you. Sura-san, the floor is yours. I want to hear your thoughts on the current state of the oil markets in the MENA region in particular. Let me hand it over to you.
Yeah, thank you, Axel. I kind of concur with what Alan said about the recovery period. It's not going to happen in 2020. If you're going to look at prices as such, we are at kind of just the starting of a bull run, and prices need to clearly establish beyond the $30 per barrel range for Brent before they can move higher. And right now, there are enough bearish elements in the market to keep the prices low. So, a word of caution to all market participants would be that kind of look at where the market is moving and look at all factors, especially elements like storage, which are still at the very high levels of the band of, like, say, the last 5 years. And these are important cues for the market to read before making any decisions.
Okay. Sudarshan, thank you very much indeed. If you want to continue now with your presentation, unless we've got the results to that second poll. Do we have the results to that second poll just yet? Give me a couple of seconds just to find out. Yes, we do. All right, 15% of you say yes, the headline numbers will be effective, given the cuts from OPEC. 85% say a pretty resounding no to that second poll. All right, thank you very much indeed. We'll come to the third poll after we've heard from Sudarshan. Sudarshan, the floor is yours again.
Thank you. So I guess I kind of concur with the 85% out here that the OPEC plus cuts are, on headline, they look big, but probably they may not be sufficient enough to ensure a speedy recovery for the markets. Yes, they have supported the prices ever since May started. However, I guess given the extent of damage that has happened to the demand, I would have expected a deeper cut in terms of production. So just to give a kind of a run through what happened, the events that happened leading to the OPEC plus cuts. The earlier agreement that the members had was kind of ending on March 31st, and the group met in March to kind of deliberate on additional cuts beyond April. However, due to differences of opinion between the members, they could not come to an agreement, and the meeting failed. That actually triggered a price war and kind of volumes being unleashed that put a lot of pressure on the markets before, again, international pressure and kind of the reality of the fundamentals kind of sinking in on the OPEC plus members. It called them back to a meeting table in April where they kind of deliberated and came out with 3-phase cuts. So the first phase is from May to June of this year, where they would be cutting about 9.7 million barrels per day. And in the phase 2, they would be cutting about 7.7 million barrels per day, and so on. So the baseline for these cuts, however, are based on the October 2018 production of the OPEC plus members. The exception to this would be Saudi Arabia and Russia, for whom the benchmark production level has been set at 11 million barrels per day. So the table kind of gives an idea to everybody who's seeing this as to what the cuts actually translate into. So by setting October 2018 as the baseline, the production was almost like 5 million barrels per day more than what it was in March of this year. So that has kind of reduced the reduced the impact of this cut on the market. So if you actually look at it in the phase 1, OPEC's share of the cut is 6.1. However, in comparison to March, it's just 3.5 million barrels a day, which is not significant considering that Q2 demand loss estimates were somewhere in the range of 20 to 30% of global oil demand, which is about 20 to 30 million barrels a day. There's nothing in comparison to what the cuts have achieved. However, this kind of led the prices to crash again, and that has brought in the market fundamentals into play. So we've seen that the US production, like Alan pointed out, have fallen significantly. It was about 13 million barrels per day in the first quarter of this year. That's come down to like 12.2, 800 KBD of US production has been lost in the month of April. So part of this could be because of storage and logistical issues. However, the impact of price could slowly start setting in because I guess the threshold for US producers would be somewhere about $30 per barrel. So anything less than that, there is no incentive for them to probably go ahead and drill more. So with that, I would like to kind of say that the cuts have been announced, but I guess more could have been done by the members. we move on to something that's curious about what Saudi Arabia did with respect to their OSPs, which is the official selling price at which Saudi markets its crude oil to different regions. So, whenever there is a production cut, generally you expect that supply is going to reduce and then prices should ideally shoot up. But what Saudi did in April when they set the May OSPs after the meeting was something abnormal. They kind of reduced the OSPs to Asia. So this was a clear signal to the market that Asia is going to be where demand is going to recover the fastest, and that's the key market for Saudi and in unison for all the other OPEC members too. So if you want to capture Asia, you want to price aggressively. So Saudi went ahead and cut their OSPs. You can see the chart here. There's been a very steep fall since the start of this year. This kind of shows that, and the June OSPs are expected to be declared anytime soon. And this has clearly shown that Saudi Arabia is taking Asian markets very seriously, and we can see a lot more flows going into Asia. So a quick roundup of how the trade flow patterns have changed over the last since the start of the year. So if we kind of look at what it was in 2019 and then the first quarter of this year and the month of April. So the blue bars for the month of April show clearly that Saudi volumes to Asia were like shooting up. And it's not just Asia, Saudi also targeted a different and like interesting market, which would be the United States. So we have estimates that about 40 million barrels of oil are on their way to the US for discharge in the month of May. So that has also contributed to the problems being faced by US producers. So let's come back to that a bit later. But so clearly, if you look at the Asia Pacific market for all major exporters from the region, it's been clear that Asia is their target region, and in the month of April, they've all ramped up their incremental barrels to go towards Asia. One another point which kind of deals with the pricing element is something interesting is that the sales that happen to Europe, Saudi kind of benchmarks it against the ICE Brent, whereas the Iraq and Kuwait barrels are priced out of dated Brent. So dated Brent, for people who may not know, is the physical barrel of oil, while ICE Brent is the futures that you see. So the difference between the two, dated Brent was trading at historical lows when compared to ICE Brent. This kind of put a disadvantage to Iraqi and Kuwait barrels in terms of their revenues. So as a buyer, you would prefer buying Iraqi and Kuwait barrels. So this is kind of going to be reflected in the May trade flows because a lot of buying would have happened in April of Iraqi and Kuwait barrels. To kind of give a number estimate, the spread between dated Brent and ICE Brent was about -$4, and this was in March, and that became -$8 in April. So that's if you're Iraq or Kuwait, you've straight about lost $4 for every barrel that you've sold. So it's interesting that how the physical market was kind of behaving slightly different from how the financial markets were performing. So we've seen a lot about how the prices have recovered recently. So this is just to give an idea of how the benchmark prices have moved since the start of the year. We saw kind of WTI going into negative territory. There are a lot of concerns whether the same thing would be repeated. Would that happen to Brent? Would Brent fall into a negative territory? I guess the market has kind of given the answer that prices have started moving up. Brent was somewhere about less than $20 per barrel just a couple of weeks back, and Brent is now trading at close to $30, $31. So this shows the rising optimism in the market with respect to where the inventory builds are and where the demand growth is expected to happen. However, I will show in my subsequent slides about the inventory, and that should kind of give an idea to the market that inventory is still high, so people need to be cautious. So there's a difference between the financial markets and the physical oil market. So it was not just the financial or the future Brent and WTI that gained. There's also the physical barrels that have like kind of strengthened. So if you look at the chart at the left, it shows the differentials of WTI Midland. It's a physical grade of crude oil in the US and that's plotted as the differentials are plotted against the benchmark. So what was trading in discounts of close to $10 per barrel has now moved into the positive territory, showing clearly that the physical oil barrel demand has gone up in the recent days. And the chart on the right kind of gives an estimate of the Brent contract for differences, which are basically the difference between a prompt barrel of oil and a barrel that's being sold in the forward. So I've plotted the 4-week comparison between the CFDs. This kind of shows that what the difference where the 4-week CFD was higher, that difference is narrowed. So kind of the contango has also dropped in the Brent market. So again, this kind of shows that the physical markets are like strengthening. So why did this happen actually? If you look at the US stocks, the inventories which were kind of published last week in the EIA report, they showed a smaller build than what was widely expected by the market. So markets right now are very sentiment driven. So any headline which kind of points to the fact that inventory build has slowed down has been taken with a lot of optimism. So that's exactly what happened last week. And added to the crude oil inventory build, which is lower than estimates, we also saw gasoline inventories drawing down. So kind of given the hope that the market is kind of seeing that US gasoline is going down, which means probably demand is starting to pick up in the US. And US being a key market for oil markets in general, so that should kind of support prices. So that's been the general opinion in the market. But if you look at other regions, say for example, ARA, which is the Northwest Europe market. Axel, do you want to say something?
No, go ahead, Sulas.
Yeah. So the stocks in the Northwest Europe market have gone up for both the light distillate and the middle distillate. So the Northwest Europe market is more kind of a diesel market, and it's surprising that the inventory build has started recently. This is largely to do with the fact that a lot of barrels from Asia of diesel have flown to Northwest Europe for storage because of the arbitrage that was available in the market. And this is kind of expected to increase because of the fact that Asian prices have for diesel have remained very low. There is a lot of supply in Asia, and eventually, if the prices fall, there can be more barrels that flow into Northwest Europe, which could in turn kind of pressure the prices in Northwest Europe. I want to look at Singapore because that's another key trading hub for oil products. And the light distillates in Singapore, the stocks have fallen, largely to do with the fact that naphtha demand has picked up, and that's because of rising petrochemical demand. So petrochemical demand is kind of an early indicator of economic recovery. Ever since China has kind of scaled down its lockdowns and a lot of the petrochemical crackers have come online, they're catering to a growing demand. So this shows economic recovery starting to show early green shoots, and that has kind of supported the naphtha market. But middle distillate stocks have kind of gone up because of rising supplies from India, and that has put pressure on Singapore diesel prices. I'd like to kind of end with the thought on economic recovery. So when the March PMI numbers came in for China, they showed a kind of a V-shaped recovery, which brought in a lot of optimism in the market. However, if you look at April, it's gone back to a contraction. So this kind of shows that China being a large export-driven economy, unless the global economy picks up, China will find it very difficult to sustain manufacturing growth. So it's very imperative that globally other regions start showing growth for China to pick up. The same way, if you look at US and Eurozone, their PMIs have been at all-time lows, and it's going to be difficult for them to pick up. So unless there is some indicator that PMI goes up in US and Europe, it might take a lot of time for global economy to recover. One positive takeaway from the US point of view is that the jobless claims, which represent the unemployment in the market, they have started going down, and the continuous claims, which represent people who are consistently looking at government support, that has started to taper off. So hopefully, with a lot of states in the US removing lockdowns, we should see these numbers becoming a lot more positive. So that kind of ends up what I want to kind of tell people out here is that be optimistic but be cautious because there are enough bearish elements in this market which can keep the prices under pressure.
All right. Surasan, thank you very much indeed for the presentation. We appreciate that. Alan, by the way, I'm going to start a Q&A session in a minute to those listening in. If you've got a question, hit the Q&A tab, send the question through for Alan and Surasan, and I will put your questions to them. We've already got several. But Alan, let me start by asking for your reaction to what we've just heard. Okay, stay optimistic, but stay cautious. Surasan, indeed, when he was talking about recovery and demand, and the recovery and demand coming from Asia seemed quite optimistic. Is it too optimistic in your view?
No, we don't think so. We certainly got demand recovery in China, in the US, and Europe as populations, quarantines end and activity returns. And in parts of the UK where you argue that the quarantine was voluntary, there's been a growth of traffic numbers, and the key major market, California, is to open up. So we're seeing those similar green shoots of recovery. The challenge becomes if there is a subsequent outbreak, another wave, in which case that becomes a further lockdown again, in which case the whole activity could end up with quite a different perspective. Mm-hmm. So the view we have is it's sort of a V, but the V, it's sharply down and it's up, not at the same pace because of what Surasan mentioned about China struggling with exports because most of the rest of the world is locked down. But we're looking at high sulfur fuel oil being reasonably strong, gasoline being weak. It's quite an odd place for the refining sector. But with the cuts that OPEC has done and the bit it done elsewhere, if we get return to demand growth, then actually the pace of inventory build for crude should slow, and we've seen that start to slow markedly. And then if we get into Q3, then we should actually see stock draws, and that'll be a signal really around pricing strength.
Sure.
But it's about OPEC plus how to happen elsewhere, and then how fast people return to normal, and whether the degree to which we have a new normal, because what we're hearing from our colleagues in China is the traffic in the major cities is back to normal levels, and arguably it's actually worse because people are avoiding public transport.
Right.
So they're going on their own personal vehicles because it feels safer.
Yeah.
So what does that mean for some of the major European cities as well? Those are some of the more interesting questions. But the one thing we do know is jet fuel is going to have a very difficult time because travel restrictions, and whether the degree to which that returns is quite uncertain at the moment.
All right, and look, thank you, Alan. I've got a number of questions coming through from listeners, so I want to go through some of these, and I'll try and keep this as organic as I can. Just back to the cuts, the OPEC plus cuts. And this comes from a listener. Concerning those cuts being considered insufficient, don't you think that we're already seeing a faster than expected rapid market response, especially from the US? What do you think, Alan?
Oh, the response from the US, or from a number of countries, has been much more dramatic. If you think of the 2015, 2016 price crash, when we were broadly down similar. Okay, this is a bit more severe. Then it took 6-9 months for US top seen a very rapid drop. You've got US production by about 1.2 million barrels today as you go from Q1 to Q3. Companies have interval mode, highly leveraged are challenging times. We quickly went to prices that it makes no sense to drill at all. So a lot of companies are taking fracking holidays, and we're seeing a very rapid reaction in the US, but we've also seen something similar in Brazil, Canada, and Norway putting a moratorium, reducing their supply. So there's been much more of a coordinated effort to act quickly, given this is not been around competition for supply. It's actually been a demand-led crisis that's established by governments.
Yeah.
So
Yeah. All
the
right.
question is, are they insufficient? It really comes down to what's your view on demand recovery.
Okay, let me just staying with the US for a second. Another story I saw on Reuters this morning on the wires. Shale producer Diamondback Energy has said it's going to consider reviving drilling plans if WTI holds above $30. Now, is that are we hearing that from other shale producers, Alan? Is that something you feel positive about? Is WTI above 30 and holding above 30 realistic anytime soon?
I think they're one of the first companies to come out with something like that. We struggle to see there being many wells that are economic with WTI below 40, because we're also, unlike last time, there was a lot of fat in the supply chain. We don't see that being the case. So we think the opportunity for drilling to restart with WTI in the 30s is very limited. To a degree, it gives a hint of optimism around their view of their position and the fact that they can return to growth and add value, but we think the opportunities are quite limited. When have we got WTI above 30? I think we've got WTI above 30 in Q4 of this year.
Okay.
So there's a few months yet before we think we're comfortably into that sort of territory.
Alan, there are a number of questions coming in on the geopolitics, and I know we need to tread a little bit carefully because this is not necessarily the hat that you wear. But let's just address a few of these if we could. First is how will the US view Saudi and UAE on the back of this? Do they still consider them allies, or do they consider them competitors in the sense of securing larger market share on the back of this?
That's an interesting question. I think there's still an element of allies within this. If you look at how this deal was brokered, it was very much US led, in terms of President Trump organizing calls and getting people together and avoiding direct competition when that was frankly doing a lot of damage to everybody. I suspect there will still be they will consider themselves to be allies, but the challenge is actually it's a more difficult place now, with low oil prices, coronavirus, economic activity will be weaker in the US, but also these low oil prices will result in austerity measures or much higher burdens for a number of Middle East governments. So it's not. I think that it makes the relationships much grayer rather than a distinct black and white.
All right. And okay, that's the politics. The other big question, of course, is the economics, and a number of questions come in regarding that. The effect on GCC economies, mainly Saudi, short and long term. Give us a quick headline thought on that. Not just Saudi, but the region.
Oh, we've got Middle East GDP being hit very hard this year as revenue stalls, activity slows. They'll need for a number of countries. They will need to basically tap international debt markets to maintain their social obligations. So we think it has a material downward impact on Saudi and Middle East economic output and arguably prospects. The challenge that we're working towards for our updated longer term view is the degree to which cuts in capex from the oil majors elsewhere actually act as a means of compensating for a lower demand growth. When we come to our medium-term outlook, we think the demand hit was in 2020, carries it to 2021. So oil demand doesn't get back to the prior levels we've had. It's hit sort of permanently. The question is, if you look at the capex, significant capex reductions from all the oil majors, that may well compensate, possibly more so than the impact in demand. So to a degree, the oil market may well tighten 2023, 2024, because a number of projects that have been factory sanctions are delayed and capex is being reduced. So we need to work our way through this. It may not dent necessarily the long-term prospects too much, but though the Middle East economies do need to diversify away from oil, and lower revenue limits their ability to do that.
All right. Alan, a number of questions as well coming through on storage. I know we've touched very briefly on storage, but I'd be interested to get your views. First up, again, a headline for: will storage space for crude and products run out? Can we avoid hitting full storage capacity? Deal with that one first, and then we'll come on to floating storage in a moment.
Well, our view is that we don't full storage. There's a distinct that's on a global perspective. There is a distinct risk that storage in Cushing gets full towards the end of May, and a lot of that will depend upon the pace at which US tight oil production falls and continues to fall. We think if we look at our sister company Genscape, their data, there's still plenty of storage left. There's still plenty of space left. Most of that space, though, we understand is leased, but we expect actually utilization to get very, very high for Cushing as we go through May. In which case, barrels will need to look at other places in say Gulf Coast. We've got high storage levels. When you go more globally, there are more storage opportunities, though reported to be full. It's not nobody has a full clear picture of the volumes available, and how is the market reacting to that? It's reacting through taking on significant amounts of floating storage.
Yeah.
And that gets massively complicated because it depends on the shape of the forward curve, but also the VLCC rates. So it's actually driven by, we've seen VLCC rates fall because OPEC production has cut. But if we're starting to see crude runs coming back up, then crude will need to move. So it's quite an interesting dynamic.
Sure.
Our understanding is the rate at which barrels are going into floating storage has materially slowed over the last week.
Okay, so in fact, a question comes through. We saw a huge spike in the volume of floating storage on the back of contango in the market. Considering the general consensus that is recovery to start only in 2021, as we discussed earlier, are we expected to see this sustained elevated levels of floating storage until then? I.e., is this going to continue in your view, Alan?
We think storage will remain high. But what we've got, if we look at the view we've got on our demand growth and OPEC partial adherence because it'll take Russia a while to comply because a number of wells need to shut down. But then balancing that all off, what we think is from Q3 onwards, the oil market will be drawing. So there'll be an implied stock draw rather than the significant builds we've had, in which case those storage levels will start to come down. But it's very much driven around the pace of demand recovery as lockdowns are eased.
Yeah. Okay. Look, I want to bring in the third polling question, if I could here. It's a little bit of a zigzag. But the question is this: have a think about this. I mean, I guess it gives us or gives Refinitiv and Al-Attiyah a picture of your priorities, those listening, and it is what tools and data points will help you make better decisions at work, real-time trade flows, pricing and swap curves, and storage and inventory data. Have a think about that. And let me throw another question to you, Alan. And this is something, again, it's something I saw on the Reuters news wire last week, and maybe you've got a better insight into how this has moved on. But it's interesting. Hedge funds, heavy buyers, it seems, of WTI over the past few weeks, which of course suggests they're positioning for a future rally. There's a focus on NYMEX. There's a focus on the ICE WTI, smaller buying in Brent. What does it say to you? Should this make us feel even more optimistic as we look further out?
Well, it gives the it's very hard to call when the markets turn. Yeah? We're expecting volatility, but the fact the hedge funds are expecting piling into long positions adds to the weight that the consensus view is that the worst period has ended. We've gone through that, and actually things should start to ease now because we've got the combination of supply cuts and demand is showing evidence of recovery. If you not necessarily in many of the government statistics yet because of their lag period for many of those outside the US, but for those who are tracking the high frequency real-time data on traffic and some of the Genscape data on storage inventories and rack data volumes, it's evident that actually demand is returning. Crude runs should then start to rise. We've got issues with product inventories, but they should start to rise, in which case the market has passed its most bleak, its darkest hour, and hence you then get the feeling of recovery. And what we've seen is such a dramatic reaction in the US in terms of tight oil production in reducing that throughput. And if you look at those levels now, then demand returning would basically suggest that actually WTI needs to strengthen.
Yeah. Okay. Suresh, I'd be interested to get your views on this as well. In fact, let's just see if we got the results of that latest poll. Whilst we wait for that, let me throw that same question to you in terms of what we read into hedge fund activity, hedge fund buying activity. What are your thoughts on that, Suresh?
So I kind of concur with what Alan said. Hedge funds in general, the market perceives the smart money to kind of have already done enough groundwork before they enter into a position. So if they've gone into a buying spree, it shows a rising optimism in the financial side of things. And we've seen some kind of corroboration of this fact even in the physical markets where crude has kind of strengthened. So hoping, like I already pointed out, that we are at a cusp right now of the start of an optimistic rally. So the next 2 to 3 weeks would be kind of very crucial. So a point of caution there again would be that the data that we get of the traders' positions are usually slightly delayed. So there is a lag between when the positions were executed and when they get reported. So that also needs to be factored in.
Yeah. Again, we're waiting for this the result of this final poll. It'll be interesting to see what the viewers feel on this. And I'm wary of the time, but Suresh, I also wanted to get your view. In fact, here's the poll result quickly. Let me run through it. Okay, here you go. 33% picked A, real-time trade flows, 19% pricing and swap curves, and the majority, 40% storage and inventory data. I guess, given what we've been talking about, Suresh, this shouldn't surprise us.
Yeah, that's right. Kind of the kind of lack of transparency around storage globally is leading the market to a point where you're just guessing. So you read reports that storage is full, you read reports somewhere that storage is not full. So you have to draw up your own estimates. So I think the requirement of the hour is to get transparent storage and inventory data across regions, and not just in like crucial markets, but right now, like for example, some of the things that people discount are people only look at storage tanks, but what about pipelines, cross-country pipelines? There's a lot of volume that can actually go into the cross-country pipelines. So like for a country like India, for example, where the geographic area is so big, there are enough pipelines across the country where if you line fill, you've stored a lot of inventory. So these are elements which do not get factored in market expectations. So it's very important to get real-time and transparent data on storage.
Okay, good. Siddharth, thank you very much for that. Alan, coming back to supply elsewhere, we talked a little bit about the US. I'll throw in a general question on the US as well, but I'd like to hear your views on where you think Russia is now as well. The question on the US, a very basic one. What do you think is the future for US shale? So that's the first question. And secondly, where do you feel Russia fits in all of this now? And where do you think Russia is going to go with this? Hi, Alan. We're not hearing you, Alan.
Oh, here we go. Is that work?
Yeah, that's it.
Good. Yeah, the old classic mute button. In terms of US shale, what we have is basically a year. 2020 is effectively a lost year. So, given the price recovery that we've got, what we're expecting is effectively June to be the month of where US tight oil effectively hits the bottom. So has lost about over 1 million barrels a day compared to the peak in February, and then it broadly stays stable in 2020 on the thesis that we have is whatever money is earned, they're returning, is getting returned to shareholders and investors to sustain viability, and then we have a very, very slow growth out of that. Even though we've got crude prices recovering, we think the companies will be wanting to address fixed balance sheets rather than revert to strong supply growth. So it's very much our expectation of corporate behaviour. If we move to Russia, what we've got is actually Russia broadly attempting to comply with the OPEC plus crude cuts. It was sort of arguably given an artificially high ceiling, but the volumes and reduction are very, very, very strong for May and June. We think it doesn't really achieve those because of the large number of wells that needs to be shut in. So we're looking at Russian supply falling through to Q3, and then it starts to recover as the OPEC plus agreements go from the very tight, significant drops of May and June to less stringent towards the end of the year, and then Russia's probably back up not far from where it's producing in Q1 by the end of 2021. So it has a shallower dip compared to say Saudi in terms of the production cuts we're expecting from Saudi Arabia.
Okay, look, again, as I said, I've got a wary eye on the time, so I would like to move to some concluding remarks. And what I'll do is I'll throw a sort of broad question to both of you, and you can use that as a springboard if you like. And it's a pretty obvious concluding question, and it's something that I'm sure a number of viewers will have picked up on based on what you've said so far, and that is about peak oil demand. Has long-term, so let me start with you. Based on what you're seeing in the market, has long-term peak demand been permanently eroded? Is this peak oil demand? Has it been reached? What are the future? Let's start with you, Siddharth.
In my opinion, I kind of think that the current scenario has shown oil producers what could happen if everything was stacked against them. So if we went in for rapid electrification of mobility, if kind of even air travel reduces and people start working more from their homes, etc. And also the fact that if there was right now what is supporting the market is petrochemical demand has started to pick up. So what if petrochemicals also face impact of plastics, etc. So the oil world has seen what it takes if everything is stacked against them. So they should be better prepared. And I guess the view might differ for different products, but jet demand, I think, on a long-term basis, it's lost its peak.
Okay, thank you, Surasan. Alan, same question to you, and let me throw in a sneaky one as well. Is there anything stopping WTI hitting zero again?
Oh, thanks for that. Right. We don't think 2019 was peak oil demand. We're expecting oil demand to be stronger than 2019 on the basis that return to economic activity and return to mobility will come. Timing is uncertain, but broadly, if we're rising incomes, rising populations, rising urbanization gives rise to a need for rising mobility, and at the moment, the alternative technologies to supply that are not from non-oil products aren't there. So just don't see the growth in electric vehicles. So near term depends on the shape of the economic recovery, but we're expecting oil demand to grow. The question is, the biggest uncertainty is around fuel as to the pace at which that recovers. But for road fuels, we think it'll be reasonably quick. If you're thinking of changing working patterns, that tends to be for people in offices in cities, but most of those people get to those locations, particularly in, say, Europe, on mass transit, public transit. So we're expecting oil demand growth to be re-established. What has this told the industry? It's this is what the world could look like in a very, very rapid energy transition. If you look at the speed of which this has happened, is the thing that there are some lessons, but you also have to be cognizant of the change, because this happens so fast. If we think of the refining industry, there are some refineries that we would argue are very, very competitive. They've gone to minimum utilization rates because the demand within their local region has collapsed so fast, and they've been unable to tap export markets. So if you think an accelerated energy transition, that won't happen at the pace of what we've just seen now. And so the world will look a little bit different compared to what's happened most recently. But we're confident oil demand will continue to grow, maybe a lower peak. Could WTI go negative again? It could well do, but I think the phrase "once bitten, twice shy" will put a lot of caution amongst US retail investors. The headline, and I'm not sure I can attribute it, which news source I can attribute it to. Its headline was Muppets versus Sharks. Sharks won, on the description of how some retail investors literally had a very bad day around WTI going negative. It's hard to see that happening again, but we do think there is an issue around potentially storage could get full. It's whether people fall into the same trap again.
All right. Alan, thank you very much, as always, for your thoughts. And Surasan, thank you very much to you as well. Thank you to everyone for attending this webinar. It is, I just want to remind you, one of the first of a series, so there will be a number of other webinars that we will invite you to. We'll be inviting guest speakers to explore all of the different energy responses and outlooks in light of the pandemic. So do stay tuned to that. The dates of those will be communicated with you shortly. The recording of this will be sent out to all of you. The slides will be available as well after the session. Again, many thanks to Alan Gelder, many thanks to Surasan Sarati, and thanks to you. We look forward to welcoming you again in the future.